Welcome back, everyone. In this module, How Accounting Works, I'm going to explain how to go about reading the financial statements of publicly traded companies in order for you to understand their investment potential. Accounting is very much like learning an entirely new language. It has specific rules and many terms and methods that might sound foreign to most people. That being said, I will focus primarily on basic concepts, structure, and best practices so that you can compare the financial results of real companies to each other and build an investment thesis. Accounting is where the real detective work of being an analyst starts, but even if you are a complete beginner, I will show you that you don't need to be intimidated or even know very much to successfully build a winning investment strategy and back it up with data. I would go so far as to say if you absorb and apply the following lessons, you will become more informed and sophisticated than the majority of retail investors in the market today. So here are the topics we'll be covering today: how businesses work, the costs associated with conducting business, understanding financial statements, and important accounting tools analysts use. Welcome again to my second module in my investor educational series, How Accounting Works, on Mind of an Analyst. In 1494, a Franciscan friar named Luca Pacioli published a book detailing a trade recording technique called the double entry style of accounting. This technique describes entering two separate entries, one on the left side and one on the right side of a ledger, in order to track a business's transactions. The elegance of this technique shows that businesses are built on symmetry. Something cannot come from nothing. And if all the elements of a business were stripped away, much like a mathematical equation, the remainder is exactly zero. Let's look at it in action on what is called a balance sheet. A balance sheet is a way to describe all of the components of a business at a specific moment in time. It is made up of three sections: assets on the left, which are the resources businesses utilize to run their operations; liabilities on the upper right, which are the debts a business owes; and equity in the bottom right, which describe the ownership claim by certain people on some of the company's assets, like stocks, for instance. The first rule of accounting is that assets will always equal liabilities plus equity. The balance sheet is also organized with a sense of timeliness and what's known as liquidity. Liquidity is a financial term which means how easily something is transferred. Cash, for example, is extremely liquid because it can readily be used. This timeliness is put into two categories: current and non-current. Will something have a useful life for less than a year? Then it's current. Or more than a year, like factory equipment, which is non-current. Now, let's build a business using the balance sheet. And again, while I know these terms may seem plentiful and new, keep practicing and re-watching this section. Once you have them down, everything will begin to make sense intuitively. Just remember, assets equal liabilities plus equity. I have an idea to manufacture and sell widgets. So I start a company and issue 1 million shares of stock, or equity, for $1 million in cash, a short-term or current asset. I spend some of my cash on a factory building worth $500,000. The factory is a long-term asset because its useful life is expected to be for many years. So I convert current assets, cash, into non-current assets, a factory. I have to buy some machines for manufacturing now. I see a deal which lets me buy the equipment I need with a 10-year interest-free loan. Perfect. The machines cost $100,000, so I take the loan, long-term debt, buy the equipment, and enter its value into long-term assets. I balance the transaction in my liability column as non-current long-term debt, because the life of the loan is more than 1 year. Okay, let's start making some widgets. I need some raw materials, so I place an order from a vendor for all the resources I need to make a widget. They ship it to me and give me an invoice for $200,000. For simplicity, let's say I automatically turn those raw materials into product, so I now have $200,000 worth of widgets in my inventory. At this moment, I haven't paid my vendor $200,000 for the resources yet, so I have that cost in what's called my accounts payable category. I owe $200,000 cash in my current liabilities column to my vendor. Let's look at the opposite side of a similar transaction and how to account for it. I get a customer who wants to buy $150,000 worth of widgets from me. Fantastic. So I ship them the product and reduce my inventory by $150,000. They haven't paid me yet, so I put that order in what's called the accounts receivable. The client owes me $150,000 in cash, which again goes under current assets, as I expect to get paid within a year. So you can see, accounts payable and accounts receivable are opposite sides of similar transactions depending on who the buyer and the seller is. There are a few notable extra categories on the balance sheet to know. One is the current portion of long-term debt, which you can think about as the minimum payment due this period for any long-term loan, and depreciation, which is a non-cash charge affecting the value of long-term assets. Remember my factory equipment I bought for $100,000? Well, I have a 10-year loan to pay back, so I expect it will be useful for those 10 years. After that, I don't think it will be of any value because the technology will be old and obsolete. The government allows me to reduce the value of the equipment each year, and this non-cash cost of my aging equipment is tax deductible. The reasoning is after 10 years, I'm going to have to pay to replace my equipment. So each year, I can spread out that expense, giving my future business a tax benefit today. There are two popular ways of assigning depreciation: straight line and accelerated. Most companies use straight line, which simply means each year they deduct the same amount. For $100,000 over 10 years, we expect $10,000 every year in non-cash cost for depreciation. I say it's non-cash because even though we are going to pay eventually for new equipment, today I haven't physically spent any of that future money yet. We will go over tricks shady companies employ with depreciation, goodwill, and other non-cash balance sheet charges in a future broadcast. But for now, get a sense of the current and non-current asset and liability categories on the balance sheet, and that assets equal liabilities plus equity. Let's turn to what's called the income statement and go briefly through the costs a business incurs in its normal operations. Generally, in business accounting, there are three types of costs: variable, fixed, and periodic. Variable costs are costs which change each period based on the amount of product produced. When I make my widgets, I have to buy raw materials, so the cost can vary with market prices, which therefore impact how many widgets I can make as well. Fixed costs are costs I have to pay no matter how much product I make. Things like rent, utilities, and salaries for my staff are an example of fixed because each month I have to pay them irrespective if I make one widget or 1,000 widgets. And period costs are expenses from special events like a marketing campaign, or paying taxes, or the fees for a lawsuit. These costs are generally not repeated in the same way each quarter, or relied upon to conduct basic business as importantly as variable and fixed costs are. Let's go line by line down an income statement. You'll see the first entry is revenue or sales. That's the dollar amount of product we successfully sold in that period. Right below you will see costs of goods sold, which tallies the expenses in manufacturing that product. This is an example of our variable costs. They'll change each quarter depending on how much we produce and sell. Next is gross profit, calculated as revenue minus our cost of goods sold. This lets us know how much money we have left over from sales to fund our operating expenses. In other words, our fixed and period costs of doing business not related to manufacturing our widgets. After cost of goods sold, operating expenses are generally described in two categories: SG&A, or sales, general, and administrative, and R&D, or research and development. Certain industries like tech and biotech rely heavily on their R&D departments to innovate new products. They will probably have big R&D budgets and perhaps smaller SG&A budgets. A grocery store chain, on the other hand, will have no R&D, which makes sense. If you see a supermarket chain with a big R&D line on their income statement, run. Depreciation, sometimes known as asset impairment expense, is also an operating expense. Remember that depreciation is a non-cash charge, so the expense reduces the total profit that will be taxed, but does not have any effect on the cash at hand. Now that we have our income and expenses from normal operations accounted for, let's calculate our operating profit. That's our gross profit minus our operating expenses. Perfect. This tells us how much money is left over to cover non-core business activities like servicing debts or other financial commitments. The next section is where things can appear a little tricky. Companies will engage in investment and financial activities like paying interest on a loan or buying and selling property, plants, and equipment. These activities are not considered part of normal operations, so when the time is due to account for any financial transactions, this is the section where they appear. It is important to pay attention to how big this non-operating section is in relation to the rest of the business, because you want to know if a company is focused on its core business activities or relying heavily on financing or accounting techniques instead to bolster profits. After we take into account the income and expenses in the non-operating profit lines, we can calculate the pre-tax earnings. After paying taxes, we have reached the final net income available to shareholders. Listed companies will number the amount of shares of stock available to the public on the line shares outstanding. The popular metric, earnings per share, is calculated as the net income divided by the amount of shares outstanding. This metric is often favored as it shows how profitable a company is. The higher the better. I have to remind you of an important distinction at this point. On the income statement, we only deal with revenues and expenses. Raising capital or debt is not considered income. It is cash, an asset, and will appear on the balance sheet and cash flow statements, which we will go through now, but it is not considered revenue because it is not earned. Let's turn to our final document, the cash flow statement. This shows the changes in cash which occur in a company over a specific period. It's an indicator of how a company acquires its cash as well as how it spends it. It is broken down into 3 sections: operations, investing, and finance. The cash flow statement gives an investor a sense of the mechanics of a company. How effectively do they manage the cash they receive from normal operations? How much of that cash goes back into the business, or is a lot of it tied up in paying off loans? Did a company spend a lot of money this period on investing in itself with new equipment or technology for a later benefit? The first section, cash flow from operations, we've essentially covered, as it represents all of the cash changes of a company due to normal business activity. Many analysts like to utilize cash flows instead of net income to judge how robust a company is. There are laws and regulations accountants take advantage of to maximize profit or sometimes maximize expenses in a year so as to pay little taxes. Analysts often prefer cash flows because they are harder to manipulate. To accurately calculate free cash flow from operations, one widely used metric in analyzing a company, you can take net income plus depreciation minus taxes plus changes in working capital. Now, working capital is an important component often referred to by analysts. It is simply current assets minus current liabilities. It is a quick measure to see if a company can meet all of its short-term debt, sometimes known as a liquidity test. If working capital is positive, the company should be in good shape and it should have assets left over from paying bills to fund non-operating activities like investment or financing activities. This means as an investor, they might be able to pay you money in the form of a dividend or reinvest in their growth, making their stock more valuable. If a company has consistently negative working capital over many quarters, it is a warning sign that the company is in trouble and perhaps is not earning enough revenue. Second, cash flows from investment describe purchases of usually long-term assets that will help maintain the business and grow, like machinery or a property. If the line is a cash increase instead of expense, perhaps they sold a piece of land or equipment. This section is important because it describes a longer-term view of where the executives think the company is headed. If there is very little investment in the business over many years, that would also be a cause for concern. Finally, cash flow from finance shows the changes in cash amounts due to the sale or purchase of stock and long-term debt. This section is consequential because if a company relies too heavily on raising cash from financing, either in the debt market or through sale of company stock, then that means they will have, if they don't already, extra pressure paying back their obligations through their cash flow from operations. I get asked the question all the time about the benefits and drawbacks of debt. Debt is a very useful tool for companies to utilize. It can speed growth and allow larger, more profitable projects to be pursued. However, if an economy turns bad or executives mismanage the funds, a company will be saddled with the burden of repayment or risk losing assets to fulfill their obligations. We will go into deeper analysis of the cash flow statement in a future episode, but just remember the three categories: cash flow from operations, which cover changes in cash from running the regular business; cash flow from investing, details money spent or received from investing in the business itself; and cash flow from finance, which are all the cash activities concerning stocks, dividends, and loans from outside financial institutions. A quick look at the cash flow statement will tell an investor if a company is strapped for cash or flush with it. To conclude, I'll speak briefly about where to find all of the public information you need about a company, as well as what some of the different forms mean. Edgar.gov is the Securities and Exchange Commission's website where you can run a search for all of the corporate filings a publicly traded company is required to file. In most cases, there are three types of filings that an investor should be paying close attention to. They are the 10K, which is the annual report of a company and is the most comprehensive filing of information on a business's practices; the 10Q, which is a quarterly report, also contains critical numbers yet with briefer notes for management; and the 8K, which is only generated when some materially critical event has occurred in the business between normally scheduled 10Q and 10K reports that investors should be aware of. Something like a major lawsuit, a plant closing down, or debt default would trigger an 8K filing requirement. It is important to pay close attention to all three of these reports, in particular to the footnotes on each page, as that is where companies often try to hide information they are legally required to disclose, but do not want to draw attention to from an investor who is closely scrutinizing their reports. The first section of the 10K and 10Q will contain thoughts from management, which is always useful to see how candid the head of a company is when speaking to investors about the business. Then the subsequent sections are deeper descriptions of the income, balance, and cash flow statements with breakout explanations of revenue and expenses over the period. As with all things, practice reading these documents and try and compare the management's promises in older filings with how successful their strategies turned out in the newer 10Ks. There are, of course, other filings as well to familiarize yourself with, but these may vary based on industry. Let's summarize. We covered building a business from the ground up and how items were accounted for on a balance sheet. Assets equal liabilities plus equity, current items listed first in a section, and less liquid or long-term items listed last. We went through how a business performed normal business operations and recorded revenue and expenses on its income statement. Then we took a look at investment and financial operations as well as cash changes on the cash flow statement. We also defined costs in a few ways: variable, fixed, and periodic, and different business transactions as operational, investment, and financial. And finally, remember to visit edgar.gov, the SEC's online reporting tool for publicly listed companies, to check their financial disclosures. The website also has help sections to better describe financial documents you may see a company file. Of course, it goes without saying that accounting can be complicated, and there are many different things we didn't cover. But I believe if you go back and replay this episode a few times to grasp the concepts inside, you will be able to understand all the financial statements you need to be a great investor. Our next episode, How Finance Works, will draw upon your basic understanding of the three financial statements each public company must disclose. So have a sense of how they flow as we get into examples of analyzing companies and their stock prices. Please like and subscribe if you found our content valuable to you, and refer back whenever you need a refresher. We have included important links below for further support to our project to educate investors, so feel free to explore more content there. Stay tuned for our third episode, How Finance Works, on Mind of an Analyst.